Hello, good day. Yeah, wherever you are in the world. My name is Alfred, and I am the owner of Cedar Tutors, and I'm here to actually just talk about something little, but this is not actually for the beginners in accounting. I have made uh, these accounts here, a trading profit or loss account. Now, this is a typical example of a sole proprietorship business. Now, this is the kind of account that at least a modern sole proprietorship business should keep, a trading business. Okay. Now, this is the account for XYZ Enterprise, and this is just the format. And the account simply states the trading profit or loss for the year ended 31st December 2000. Okay, and now I'm gonna explain what all these postings are. Okay, now for every business, it's expected that at least a business should have goods. That is, if it's a business that sells. Okay, this is not actually for services. Now, these goods are actually called stock. Now, for advanced accounting, we don't call them stock; we call them inventory. Okay. Okay. Now, this stock is what the company actually trade in to make profit. Now, when the business now with this particular account, we are gonna assume that a business, this particular person has been in business for more than a year, and this is just one of the accounts that is being kept, yeah, in the business, which is for 2000. Let's assume that the business has been since 1998. Okay, now, so let's say if the business is running from 99 into 2000 now, and the person wants to start, let's assume that the business year starts from 1st of January 2000. Now, as of 1st of January 2000, just follow my cursor. As of 1st of January 2000, the owner gets goods that were remaining from the previous year and brings it to the next year. Now, those goods in the next year will be termed opening stock. Okay, so that is the number of goods used to the amount of goods or the value of the goods that is used to start the business for that particular year. Now, if those goods are not enough, now the sole proprietor can decide to buy more. Yeah. So when the person buys more, it's termed purchases. Purchases. So you add the cost of the purchase to the opening stock. Okay. Now, and when this person buys goods, it's expected that this person actually incurred a cost to also carry those goods from where it is being bought to the business place. Okay, so this is also termed what we call carriage inwards. Okay, so you add carriage inwards to your purchases. Then there are times when this person might buy goods, and the goods are maybe some of them might be faulty. Now, those ones that are faulty might be returned to the supplier. Now, this term is called return outwards. Return outwards. Okay, so you deduct that amount or the value of the returns from the purchases. Now, when you value this purchase amount and the carriage inwards, then less your returns, the value you get is called your net purchases. And this is what you put here. Then you add it up to the opening stock. Okay, now when you add the figure of the net purchases to the opening stock, the value you get here is called the cost of goods that is available for sale. Okay, so that is the cost of goods that is now available for sale. Okay, now let's assume that within the business period, the seller sells, or the owner of the business now sells. Now we are coming to the credit side, which is on the right hand side. Okay, the person sells these goods, some amount. Okay, now this is where you put the amount. Now this is a dollar figure. It could be any currency at all, depending on the country you are in. Okay, now sometimes when we sell these goods, we might not know that some of them were bad. Now our customers, that is XYZ customers, can decide to now return those ones that are bad to us. So those ones that are bad that they return to us is now called, that is to XYZ, is now called return inwards. Return inwards. Okay, so when you less it, when you less the value from sales, the amount you will get is called your net sales. So that is the actual sales that you get. Okay, now good. Now when you bring this amount down to this place, you now have to deduct it from, okay, sorry, after your cost of goods sold, you after selling, they assume that at least you have some stock left. So those remaining stock as at the end of the trading period is called your closing stock. So you less the closing stock from the cost of goods available for sale. Now, when you less it, you now get the figure called the cost of goods that was actually sold, the cost of goods sold. Okay, so this is the cost of goods sold. Now, when you deduct the cost of goods sold from this net sales here that you bring here, your value that you will get will now be called your gross profit. Now, the gross profit is the profit you make during the trading period, during the trade period. So this account that ends here, from here to this place, is called your trading account. That is why we have it as trading, comma, profit or loss account. Okay, so that is that. Okay, good. Okay, quick one. Oh, sorry, I tampered with this. Okay, quick one. Um, quick one. You know, um, after a business as is done with the trading, there are some expenses that might said to be incurred. There are some expenses that might be incurred and some income that might be received. Okay, are we following? Okay, now, when the expenses are always debited, they are always debited to the profit or loss account, and the income accounts are always credited. Now, this, like I said, this lecture is not actually for beginners. It's not for beginners, but I'm still taking my time to explain every single details. So expenses are those amounts that the business incur during the business period for the year. Okay, and this could include salaries or wages. You know, the company has to pay, or the business has to pay its workers, and the company could also, oh sorry, why am I using the word company? The business could also insure, the owner of the business could insure his business or our business. Okay. And again, the owner could have borrowed loan or collected loan from the bank, and might, it could even be from a friend. You know, the person could collect loan from an institution or a person, and there might be an interest, an agreement to pay the certain amount that the person needs to service for the loan, for a period of time, and maybe on a monthly basis. Now, this interest on the loan has to go to the expenses because it's an expense to the business. Okay, now carriage outward is also an expense to the business, because sometimes they would want to, actually, the business owners would want to give customers preferences, maybe to carry their goods from the business place to the customer's destination, without the customer paying for it. Now, this is also an expense to this XYZ business. Now, sometimes the business could also incur bad debts. Bad debts are debts that are not recoverable. Okay, so if some customers that are owing refuse to pay their debt due to certain circumstances, now the business incurs this bad debt, and we term them as expenses in the trading, in the profit or loss account. And sometimes the business could also buy, writing materials, postages and stamps, send letters and all that. Okay. Now, these are expenses. The business could also pay for rents and rates. Yeah. Okay. And these are expenses. Now, the business could also incur certain amount of transportation. These are expenses. And the business could also provide for these bad debts that have been incurred. Customers are not paying these debts, and yet you are making provision for these bad debts from your profits. Yeah, you are making provision from the bad debt from your profits. It's an expense to the business because we are using it to service the bad debts. Okay, in case customers do not pay for it. Okay, now there's also the discount allowed when the business owner XYZ gives discount to customers. It's an expense to them. Yeah, maybe for buying certain amounts or paying on time. Discounts are given for different reasons, or maybe for patronage. Okay. Now, now the next one is depreciation. Now, these are actually done on fixed assets. Depreciation is usually done on fixed assets. Now, the amount of the value of the value of the depreciated amount of the fixed assets usually comes to the expense side. Okay. Now, and is also treated in the balance sheet anyways. Even provisions also treated in the balance sheet. Interest on loan. Okay. Sorry, the loan is also taken to the balance sheet. Okay. Now, I would also come to the balance sheet later on, probably by next week. Okay, so electricity is also an expense. Okay, so the business also incurs some certain amounts to pay for electricity. So this is an expense. So everything expense comes to the debit side. Okay, now quickly, now we had gross profit from this. We bring it down. We'll call this part here the gross profit carried down. Then we'll bring it down to the income side. It's profits made during the trading period, so it's an income. Okay, so it comes to the income side. Okay, now as it comes to the income side, you add up other income to the amount there. Okay, now discount received. Now, when the business XYZ buys goods from its suppliers, the suppliers could decide to give them discounts. So when they receive discounts on the products that they buy or the goods that they get or they buy or they purchase rather, they call that amount the discount received, or maybe they paid on time. Yeah, so they receive certain discounts. So it's an income to us, XYZ. Okay, now when we receive rent, maybe we have a place we give out on rentage. When people pay the XYZ business, we call that income, I'm sorry, rent received, and it's an income to us. And the next one is other income. There could be other kind of income depending on the question given. Now, when these amounts are added, when the amounts here are added up, you get this. That is what you also put on the other side of the account, on both sides of debit and credit. Now, when you do that, you add up this whole amount of expenses and deduct from this amount. That is what gives you your net profit carried down. Okay, now this is just simply a typical example of how a trading profit or loss account looks like. Now, I am using an Excel sheet because I think it is the best way to present this. Okay, now I hope this actually helps. I do not want to make this video too lengthy. Okay, so I hope this actually helps. Now, if you have any question, you can leave that. Okay, remember, classes are going on online. You can enroll for an hour class for $25, or you can enroll for an hour 30 minutes for $30. Okay, so please quickly reach out to me using the email below, cedartutors@gmail.com, now to actually book a class online. Tell me what you want to be taught, and would fix a convenient time on both ends. And I hope you enjoy it. Thank you. I'm Alfred once again for Cedar Tutors.